The stock market has gained on Monday's trading session after absolutely nothing happened to cause it to move upward. Wait, what did I say? You heard me correctly. The market is anticipating good news coming out of the trade talks, and so the market has risen. What information do they have? None whatsoever. But if you ask the CNBC correspondents, currently 0% of those surveyed believe that the stock market will fall. Seems heavily biased to me. Oh well, you came here for the truth, so let me unveil that for you. Today we're going to look at what's happening in the markets. I'm going to show you what the CNBC correspondent said in this absolutely biased survey. It's hilarious. Then we're going to talk about the IMF. We're going to look at Ray Dalio's performance. We're going to look at the central bank assets. I have a jam-packed video, way too much to get into, so let's begin right away. You're looking at the markets right now as I record this in the middle of the trading session on Monday. You're seeing the Dow Jones up 150 points. It's been a volatile day, up and down, but here we have it at this time in the positive territory. Let's move into the article that corresponds with that. Stocks rose in a volatile trade on Monday as investors poured through the latest US-China trade developments, and equities added to the massive rally in the prior trading session. All of this is bullish news trying to help the market recover from what was a very significant fall. They're talking about Amazon rising here, Amazon becoming the biggest company. It's so wonderful. More money is funneling towards a handful of corporations. Majority of Wall Street pros see a stock market comeback led by tech in 2019. Of course, it's always tech. That is the very last safe haven of the stock market. If you want some growth, this is where you have to put your money. Of course, they saw what the result of that is just in the last few months. Basically, I'll show you some of the information coming out of this survey, and it is quite a funny one to look at. Now, let's begin with this one. US equities are cheap, 59% of people, correctly valued 41%, and 0% say it's overvalued. They didn't survey me, obviously not. View of recent downturn, good buying opportunity, 69% of people. 28% say they're stuck in a range for a while, and 3% say the worst is not over with. That's statistically insignificant. Most people think that this is a good buying opportunity right now, the so-called quote-unquote pros. Will the Fed cut rates in 2019? 90% say no. So we'll see what they do here. Interesting, I thought they would actually fool themselves into thinking that they would actually be cutting rates in order to support asset prices, but 90% of them think that they're not going to cut rates in 2019. Overall stock market outlook, 0% of these individuals have a negative outlook right now. Neutral 34%, positive 66%. Can you believe it? Zero. Not even a few people think they have major headwinds against them right now. This is absurd. So let's look at this one here. Will tech make a comeback in 2019? 83% who obviously have so much skin in the game, their job, their own personal assets, 83% say yes. People are desperate at this point. It's pretty obvious, and you can see that from this survey. I found this to be an interesting chart that I wanted to make sure that you were aware of it. I talked about this, but now I actually have the chart to back up what I was saying. Big jumps, moves of greater than 2% have been more common in recent weeks. So you're looking at this from essentially the beginning of October up until present. The S&P 500 has seen more volatility, yet that has not been present in the VIX index. So you know that it's a fake index because of this. We've seen this moving up and down rapidly in an uncertain fashion, but this is what you get when you have central bank quantitative easing messing up everything along the way. This is a quote out of the IMF. The next recession is somewhere over the horizon, and we are less prepared to deal with that than we should be, and less prepared than in the last crisis in 2008. That's what the IMF is saying right now. You know, whenever they suggest something, I completely agree 9 times out of 10. It's their solutions and the way they go about robbing countries that I'm not exactly on the same page with them. But when they point at something, it is usually right on the mark. So what's going to happen this time around? How will the world be able to prevent a crisis this time around? Well, what did they do last time? They printed a whole bunch of money and they reduced interest rates. Well, what about those countries that still have 0% or even negative interest rates? What are they going to do? Well, they're going to go further down. It only works so much. It's not as if you could put interest rates down to, let's say, negative 50%, and then that would have a major impact. It would start to boost things. It doesn't work like that. They bring them just into the negative slightly in order to facilitate some level of boost, but it doesn't really work like that in the way that most people would think, that there's a lot of room to go down. It's not the way it is, okay? So we know that already, and yet these countries right now, whether you look at Japan, Switzerland, or other places in Europe where you have negative interest rates, it's not a good thing when you can't really get any more out of that. You're going to be faced with a very big issue when you've exhausted all of your options. Given this, countries should be paying attention to keeping their economy on a level trajectory, building buffers, and not fighting with each other. Obviously, the trade issues are a concern for the IMF, and they're hoping that this gets resolved, and certainly most people are. I don't know what's going to happen. I think we'll get some token news out of this, and they'll try to make it so wonderful for the media to present to everybody, and the stock market will rise as a result. And that's the short term. The longer term will not be discussed by the mainstream media. I've got some information on that. But first, I wanted to look at Ray Dalio of Bridgewater. The world's largest hedge fund posted a 15% gain last year after calling the global economic slowdown. It's funny that in 2018, Ray Dalio was considered to be this wise and intelligent investor, but 2017, especially towards the end of the year, he was being laughed at. And why? Because he started to short Europe. And in doing so, while we were having relatively sound investment on a global level, he started to see the writing on the wall. So he shorted, then he added to his position, then he added. At one point, he had billions of dollars in his positions on shorting Europe, and everybody was ridiculing him, from people who know absolutely nothing to the supposed pros. And then he profited big time in a world where most of the hedge funds had dismal performance. He gained 15%. Nearly every major asset class ended the year in the red, including the S&P 500, which declined almost 7% excluding dividends, and yet he was able to get some profit off of this in a very bad time. So he knew that the global economic slowdown was happening. If I say it though, then I'm wrong, I'm negative, I'm bearish, I'm a fool, I'm a fearmonger, and all that stuff. But Ray Dalio posted 15% profit off of that, and somehow he's praised for it. Oh well, no worries. I want people to know exactly what happened from the financial crisis up until present day, and you can see this from Northman Trader. As the asset prices started to fall, you see the introduction of QE1. Alright, so they started to print money. They thought this would be a good idea. You see what happens. Alright, now QE2 kicks off. Operation Twist. QE3, but then they stopped QE3. And what happened there? The stock market started to lag. The stock market started to fall. And we saw this getting beaten up at this point. It wasn't quite as severe and dramatic as what we saw in 2018, but certainly the market started to fall. It was looking weak, looking really bad in China as well. Globally, things started to turn over. And then we had central banks around the world deciding, all right, we got to pick up the pace here because the Fed isn't doing it. They're going to hold their balance sheet where it is, but we are the ones who are going to have to print money. And greater than $5 trillion was printed over the next few years in order to get this to continue on. And it did, absolutely. People don't realize that. They don't know what the hell is going on. All they know is that they've bought FANG stocks and that they have risen since the point where they bought some of them. You know, there are 7 shares of Amazon, which is so valuable to them. This right here just tells us exactly the level of monetary easing that has taken place. People need to know this. It is very important to understand the central bank and their actions because you can't get around it. You can't be fooled in this case here. how the balance sheets grew. Assets held by the US Fed, ECB, and the Bank of Japan. This is on a quarterly basis, and obviously over the course of financial crisis and beyond, we've seen the assets of these central banks expanding. But what is different now is that we have seen a decline in the assets. As you can see right here at the peak of this chart, it has come down from basically the beginning of 2018. It peaked out, and ever since then, less and less and less remains on their books. It is important to look at the Fed's balance sheet, the ECB, the BOJ, the PBOC, the BOE, and the SNB, and every other letter of the alphabet, and understand what they are doing at any given time, because these days, that's all that matters. Unfortunately, all the fundamentals are gone, all of the normal factors are thrown out of the window, and the only thing left is central banks. So in seeing all this information, it should tell you exactly where the future state of the markets are. If they print more money, unequivocally, we could see a rise in the markets. If they decide to continue to pull money from their books, allow the assets to mature, sell them off back onto the markets, whatever the case may be, then of course this will fall along with it. We don't know exactly what will happen at any given time, but when you take the crutch away, you see the things falling in their face. Things look tighter down the road. Net asset purchases for the three major central banks have already fallen and are set to turn negative in 2019. This is one of the most important factors that you will find right now. This is not covered generally in the mainstream media, not understood by all of the individuals who unfortunately are managing people's money. It's quite sad. You're looking at January 2019, where I just highlighted, and you could see that it is turning negative at this point. Yes, we do have the BOJ printing money, and we know that. We know what's going to happen at this point. They're the only ones left, essentially, that are printing money, and this is declining at a rate where we know in 2019, if they keep to their promises, we're in the negative territory, and that is very, very bad, because one central bank is not enough to keep the whole thing alive unless the Fed is going to begin QE4, and I don't think they're ready to do that. They don't want to do so. If stocks rise from this point because the trade issues are quote-unquote resolved, then of course we'll see interest rates rise at the next meeting, and that's gonna put a huge damper on everybody's game, and they're gonna cry and they're gonna moan, and the assets will feel it. You know, it's funny, the market has been trading positively based on information that was false, and still, to this day, there's been no mainstream news about this at all. I covered it very clearly. I documented this, how the Federal Reserve, in fact, hasn't changed their position at all, yet the mainstream media spun this in a way to make it seem positive for those who invest heavily in equities, not to be in fear. But I'm just really surprised that even other alternative news outlets haven't really been talking about this. It was right there in the meeting minutes. I just showed you. Didn't take a genius to figure that out. And here we have it. But yet the market is loving it. Still, it's loving it. Loving the lies, eating it up. And just a little bit of humor to finish the video off. How long FTSE 100 CEOs take to out-earn the average worker. Working days needed for the FTSE 100 CEOs to make the average worker's annual earnings. Guess what? 3 days, 29 hours. In 2018, 31 hours were required. So it wasn't long before the CEO had earned the exact amount as the average worker. Only 3 days. They could take the rest of the year off. Congratulations. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. And last but not least, if you want the financial education you were not taught in school, these two books have everything that you need. You can get all the data, all the details at Amazon in the link below. And if you're more interested in the audiobook version, you can get that at themoneygps.com.